Imagine a respectable insurance company, a pillar of stability, secretly making bets so reckless they nearly triggered a global financial apocalypse. Bets on the housing market worth $500 billion. When it all came crashing down, taxpayers coughed up $182 billion to save it. And the architects of this disaster? They walked away with millions in bonuses, even amidst the chaos. This is the story of AIG, a man named Joseph Cassano, and the $527 billion wager that almost destroyed Wall Street, throwing millions of lives into disarray. How did one man, leading a single division, gain the power to bring an entire economy to its knees? And why did no one see it coming? For decades, AIG, American International Group, was a global insurance behemoth. They covered everything from hurricanes to car accidents, a symbol of financial security. But hidden within this colossus was a rogue operation, AIG Financial Products, or AIGFP. And at its helm, a brash, confident man named Joseph Cassano, hired in 1987 as one of its first employees. While AIG handled traditional insurance, Cassano's division delved into the shadowy world of complex financial instruments, specifically something called credit default swaps. Think of a credit default swap, or CDS, like an insurance policy. A bank or another financial institution would pay AIG regular premiums to insure against a loan defaulting. If the loan went bad, AIG would pay out. Simple, right? But the devil, as always, was in the details. These weren't just any loans. They were bundled, complex mortgage-backed securities, known as collateralized debt obligations, or CDOs. And AIGFP was about to become the largest insurer of these highly volatile assets. Cassano's operation at AIGFP started quietly, but by 1998, they began actively packaging and selling these CDSs on CDOs. The real turning point came in the year 2000. That's when the Commodity Futures Modernization Act was passed, a piece of legislation that would prove catastrophic. This act effectively deregulated over-the-counter derivatives, including these credit default swaps, removing them from federal and state oversight. Suddenly, Cassano's team could sell hundreds of billions of dollars worth of these insurance policies without having to put up significant initial collateral or set aside adequate capital reserves. It was a gold rush. They were essentially selling promises backed by very little and collecting massive premiums. AIGFP's CDS portfolio swelled to an astonishing $527 billion in notional value, with a significant $61 billion directly tied to subprime mortgages. Cassano himself became a financial titan, accumulating an incredible $315 million in compensation between 1987 and 2008. He was untouchable, presiding over a division that was raking in billions for AIG, seemingly without risk. So, how exactly did these credit default swaps become such a ticking time bomb? Imagine buying fire insurance for a house. You pay premiums, and if the house burns down, the insurer pays you. A CDS works similarly for a loan, but AIGFP introduced dangerous twists. First, AIG was selling these insurance policies on hundreds of billions of dollars of mortgage-backed securities without needing to hold enough actual cash or capital to cover potential payouts. It was like an insurance company selling policies to an entire city, but only having enough money in the bank to cover one house fire. Second, and even more speculative, you didn't even need to own the house to buy insurance on it. This led to naked CDSs, where parties could buy insurance on an asset without any direct exposure to its debt. They were purely betting on failure. Banks bought these CDSs from AIG to protect themselves, but also to speculate. When the housing market collapsed, the value of these mortgage-backed securities plummeted. This triggered collateral calls from the protection buyers. They demanded AIG pay up immediately. But AIG didn't have the cash, creating a massive liquidity crisis that threatened to collapse not just AIG, but all the banks it had insured. Even as early as 2007, the housing market was showing cracks, but Joseph Cassano remained defiantly confident. In August of that year, he famously declared that it was hard for us to even see a scenario that would see us losing $1 on their CDO transactions. A truly stunning statement, given what was coming. Yet, behind the bravado, the first cracks were appearing. That same month, investment bank Goldman Sachs, one of AIG's counterparties, demanded $1.5 billion in collateral. It was a sign that the market was starting to price in risk, a risk Cassano was publicly dismissing. By November 2007, AIG reported $352 million in unrealized losses from the CDS portfolio. It still maintained it was highly unlikely to lose money. Then, in February 2008, the truth became harder to hide. AIG disclosed a material weakness in its valuation of these swaps. Under growing pressure, Joseph Cassano resigned. The architect of this vast, unregulated empire was gone, but the damage was already done. The fuse had been lit, and the countdown to catastrophe was accelerating. As the U.S. housing market spiraled into full-blown collapse in 2008, the true scale of AIG's reckless bets became terrifyingly clear. The value of those mortgage-backed securities, the ones AIG had insured, evaporated. Suddenly, all those financial institutions, AIG's counterparties, started demanding their money. They issued collateral calls, billions upon billions. AIG, without adequate reserves, was bleeding cash. On September 15, 2008, the dam truly broke. All three major credit rating agencies downgraded AIG's credit rating, a move that immediately triggered an additional $13 billion in new collateral calls. In total, AIG faced $32 billion in calls it couldn't meet. The company, once a symbol of stability, faced an acute liquidity crisis, teetering on the brink of collapse. Panic spread through Wall Street. AIG's failure would not just be another bankruptcy. Its intricate web of CDS contracts was so deeply intertwined with major banks worldwide, Goldman Sachs, Deutsche Bank, and many others, that its collapse threatened a domino effect that could decimate the entire global financial system. The U.S. government had no choice. On September 16, 2008, the Federal Reserve Board approved an unprecedented $85 billion emergency loan to AIG, effectively nationalizing the company by taking a 79.9% equity stake. It was a desperate, last-ditch effort to prevent a total economic meltdown. The initial $85 billion was just the beginning. The total government bailout of AIG eventually swelled to a staggering $182 billion, paid for by American taxpayers. Treasury Secretary Henry Paulson later implied what many suspected, that the AIG bailout was partly a covert bailout of Goldman Sachs and Wall Street and foreign banks, as the money flowed through AIG directly to its powerful counterparties. But the consequences weren't just about banks and billions. The broader financial crisis, exacerbated by AIG's near collapse, unleashed devastation on Main Street. Millions lost their jobs. Families lost their homes to foreclosure. Retirement accounts and pension funds were decimated as stock markets plummeted. The human cost was immense. And then, the ultimate slap in the face. In March 2009, after receiving billions in taxpayer money, AIG paid out $165 million in employee bonuses. This, combined with reports of AIG executives holding a lavish $400,000 retreat just days after the initial bailout, sparked immense public outrage. Ordinary citizens were struggling to survive, while the very people who caused the crisis were being rewarded. It was a stark illustration of injustice, fueling a national fury that echoed for years. AIG's story is a chilling reminder of how opaque financial instruments, unchecked ambition, and a lack of regulation can bring the global economy to its knees. Joseph Cassano's confident, almost arrogant, belief in his models and his products proved to be catastrophically misplaced. A company that was supposed to provide insurance against risk became the greatest risk of all. The $182 billion bailout saved the financial system, but it came at an enormous cost, both financially and in terms of public trust. The lessons learned from AIG are profound. The interconnectedness of our financial world, the dangers of deregulation, and the need for accountability when reckless gambles threaten millions of lives. But has Wall Street truly learned its lesson? Or are new, complex instruments already being forged in the shadows, waiting for the next collapse? The question lingers, a silent warning for the future. If you found this dive into financial catastrophe gripping, make sure to subscribe to the Collapse Files for more true stories of greed, fraud, and the empires that fell.